Welcome to CEO Interviews, a production of Agoracom, in which we take the time to speak with small cap executives about recent important news and other great stories at their companies. With us today, for the first time, I'm happy to have Michael Dane. He's President and CEO of Fairmont Resources. The company trades on the TSX Venture Exchange under the stock symbol FMR. For our friends in the US, FRSSF, and for our friends in Frankfurt, FO01. Now, for those of you who are new to the Fairmont story, Fairmont is a rapidly growing industrial minerals and dimensional stone company. Now, more than just lip service, what does that mean? The company recently announced a major acquisition of industrial minerals business in Spain, while the company's Quebec properties include 3 quartz, quartzite, and amongst other things. Here to talk about those more is Michael. Michael, welcome to the show.
Hi, George. Thanks for having me.
March 21st. You made a major announcement to acquire a bankrupt dimensional stone company from Spain. How big is this acquisition?
It's quite a large acquisition in the granite space, especially in the European market. It would make us one of the largest integrated producers, right from the mine site to the finished product. Would have over 23 quarries, and it gives us this size, fully operational finishing, cutting. 250,000 square meters of annual production, a 40,000 square meter factory, an operational fleet of mining equipment, processing equipment, trucks, cranes. It's all there ready to go, and it even has inventory sitting in the factory ready to be sold.
Yeah, so I'm glad you brought that up, because what does this mean from a give me some financial highlights of this, what seems like a pretty large enterprise.
Sure. So the total acquisition cost, including some fees to some consultants, is about $4.275 million. That also includes a acquisition of one of the quarries. I call it a premium stone quarry that had been sold off to one of the creditors during the receivership process, and we were able to have everyone agree to bring it back into the deal for a portion of cash. Then there's the factory with equipment, the quarries, the inventory. The whole package together, we've negotiated for 4.275 million euros. The receiver valued that package at 60 million euros at receivership value, and we value the replacement value at plus 100 million euros.
So okay, so none of that is misspeaking or a typo. You're talking about you picked up for just over 4.5 million euros, and book value is 60 million euros here.
Discounted book value, that's right. Fire sale price 60 million.
So that's a coup of epic proportions. What does that mean for you, or what does that mean for what the business looked like when it was operating on the revenue profitability side? Because naturally people are going to ask, and I'm thinking this out loud, that if it's such a great business, why to go bankrupt? So tell us first about the kind of the income statement, and then tell us where they went wrong.
So annual sales were averaging over the last 5 years of commercial production were over 6 million euros per year. The profit margin was over 30%, so it had a nice healthy margin on the profit. It was only selling product in Europe, and in 2011, this kind of leads to the second part. What went wrong? 2011, the European market just died. It was a recession in Europe, especially in Spain, Greece, and Italy. The team had done a major capital investment the prior 3 years. So from 2008 to 2010, they had modernized a lot of equipment, and that they brought in as debt. So you've got a kind of a compounding issue of debt coming in and sales disappearing, that a couple of the creditors called in their debts. The other large creditor was the government, and the government is actually the most supportive in this deal. Looking at it not from a we need our money back right away. They're saying we need jobs in the region. So really the reason the price is so low is not because everyone's jumping ship and getting out of Dodge. It's because the government is the largest creditor, and they go, it's more important for us to get 50 to 100 people employed than it is for us to make that capital investment back. And they look at it as a long-term crutch or anchor to this region. It's a focal point for the region.
So devil's advocate here, how do you make up for the fact that, in fact, because I don't think things have changed when Spain, Greece, and Italy and those areas are still suffering economic weakness. How do you foresee your team subsidizing that and making sure that you can make this profitable again when you guys are up and running?
Well, there's lots of pieces that have changed in the past since 2011. We've got labor costs have gone down in Spain, so immediately you've got a 10% cost savings on your operations. We have a good market in Germany, the Netherlands, Belgium, which were customers, and in 2011 they got hit as well. So some of the stronger economies in Europe are still growing and still developing. I mean, you'll see Grabasa Stone. It's the Daewoo Tower in Warsaw, Poland. That's like a anchor piece of real estate in Warsaw. You've got subway stations in Germany. You've got shopping malls in Holland. Development's still continuing. It's continuing at a much more rapid pace than it was 4 or 5 years ago. And it might not have again in Spain or Italy or Greece, but we're looking at, look, we're a Canadian company. We're based in North America. Why not take some production from Spain and bring it here? Because a lot of other companies do that already. There's companies from Italy, companies from Portugal. There, you know, a lot more marble you'll see coming from Italy and into the North American market. But Spain is known for its high quality granite, so we can bring that into the North American market. And assume we just get 10% of our sales in North America. It's not a really, it's a big piece to us as Fairmont. But to the U.S. market, the U.S. market's $2.5 billion. If we add 2 million Canadian in sales in the U.S. market, that's huge for us. There is a rounding error on the overall market. And we have a premium quality product. The colors are, the grays and blacks are a little more unique than what you see. I mean, there's lots of pink granites, there's lots of gray granites, but these ones have a nicer texture, a nicer pattern. So you're getting a premium price. So the wholesale prices range, there's a 10 to 15 euro difference in wholesale price minimum to maximum on our product range because there is such a high premium value on certain colors. And to get that into the North American market, I think we'll do quite well. The other market that really wasn't tackled other than a few large towers in Singapore is the Asian market. And black is the color of demand in Japan and China. And I think all we have to do is get 3 or 4 containers over there a year, and it makes a material difference to our balance sheet. And that's less than 1 office building going up. So you just think of the development in Malaysia and anywhere on the Pacific Rim, we have good access to that market as well.
And I think what really makes sense of what you said, back in 2010, 2011, everywhere, there was a problem everywhere. But since then, we've seen a pickup in Northern Europe and all the strong economies around the world. They're obviously getting stronger. And so you're not going to have the same problems that the previous owners did. So it sounds like you have a great plan in place. When does it look like? How does, because it's a proposed acquisition, you still have to put some financing in place. How is that looking, and what's the ETA for the potential closing date?
I think the final closing date will probably be early July, and we have several groups with debt that I think we're comfortable that the debt will close. We are going to do a little equity raise for G&A in the meantime to keep the Quebec operations going and put a little more of a deposit down on the Spanish assets. So, you know, somewhere between 300,000 and $1 million we'll try to raise in the next few weeks. But the Spanish acquisition, we're looking about 12 million Canadian to close that. So we have not just the acquisition price, but working capital there so that we're not going to go back to creditors in 6 months and say, hey, we need a little more cash because we haven't got the sales up and running in 3 months. We want to get our sales. We expect to have cash flow in 90 days, but you can't guarantee anything because we are shipping a commodity that we can't control or getting it to Asia. It might take 30 days just to get it out of the country.
But I did find that interesting because you had said earlier, there is inventory that's ready for sale and ready for processing right off the bat. So it's not as if you have to get the whole machine up and running. You've got a lot of meat sitting on the bone just waiting for you.
Right. We were quite happy with that too, because the valuation on the inventory at discounted, so fire sale value, if you want to call it, is 2 million euros. Probably closer to 5 or 6 million euros in actual sale value as at wholesale price. That's not a retail price. So if you think about what you're going to put in your kitchen or your dining room floor, multiply that by 3 or 4 times, because that's what the retail price will be for that. And I guess the other big benefit is we've got unfinished inventory too. So we don't even have to start quarrying immediately. We've got big blocks of granite in the yard, in the factory, that can start being cut. So not only is there cut material ready to sell, there's uncut material ready to run through the factory. You get this going, you can kind of do it nice and staged. Get the sales team up and running, get the management team up and running in Spain, and then bring in the operators to the equipment, do your maintenance, start it up, and then bring the quarries on 6 months down the road. So do it as a nice staged process. And in the interim, there are lots of other granite producers in the area. We can buy inventory from other guys. We can look at accretive acquisitions in the region. I mean, we are a nice central location. We've got 23 quarries within 20 kilometers of the factory. Why not look in that same radius and see if anyone else has got production that wants to be part of the new Fairmont? And I think that gives us a good opportunity, because there's not a lot of guys with the ability to do this finished processing there. There's lots of little mom and pop quarry operators, but why not become part of the whole team, have better marketing, have better access to the global markets? And I think we'll be able to provide all sorts of.
That makes sense. So it sounds like you guys have an amazing acquisition target, and at the same time a great plan, because you're going to be able to essentially bring economies of scale and globalization and all sorts of goodies to the local, to the other suppliers in the market, and you're probably going to be able to bring great value and achieve great value for the company as well.
Yeah, other than the sales team that used to work at Grabasa, they were a very local company. They had sales team across Europe, but they didn't have an international presence. As you know, Fairmont being in Toronto, close to New York, I travel to China 2 or 3 times a year. I mean, I'm already doing this international commerce. So it's just supplemental to what we're doing. And because we have other industrial minerals, it becomes part of a catalog. We can offer you ABC or the granite. So our sales guys can walk around with 2 different catalogs when they're selling their material. Because industrial minerals, the other thing that's a lot different from it than gold and copper or other metals, you don't have a spot price. It's all negotiated contracts, and it's all about this. It's really the relationship between the salesperson and the customer. And that's really the big difference between gold or copper and industrial minerals.
And let's talk about that. So we got a couple minutes left here. I want to really focus on this acquisition, and I'm looking forward to hearing more about that towards the end of July, when hopefully this all gets finalized, and then the sky's your limit at that point. But you do have a heavy focus on industrial minerals, whereas a lot of companies in this space want to focus on precious metal, gold and silver. So in a minute or two, let's talk about why that focus on industrial minerals versus what seems like the easy money on the precious metal side.
Well, there's a couple of things. My background, I started working at Goldcorp back in the 90s, and Goldcorp had industrial mineral operations. Not many people remember them, but they were nice little cash cows. They didn't have as much volatility as other commodities, but every year we were getting 30 million a year steady. 28 one year, maybe 31, but it was a nice average versus this spike of up 50%, down 50%, up 20%, down 20%. It was plus or minus 10% maximum, and it was really a really easy to understand business. It was dig it out of the ground, process it a little bit, sell it to your customers. Permitting for industrial minerals is typically a lot faster than it is for metals. Your tailings, if you have any, in our cases in Quebec, we don't have tailings. For industrial minerals, we sell the whole thing that comes out of the ground. So tailings is not an issue. You don't have a mine that's going to be permitted for 20 million tons underground. You're looking at a closer to a gravel pit in southern Ontario or anywhere else. It's a different permitting regime for the most part. Sometimes you've got a little bit of iron in one of your rocks, so you have to change to a different mining permitting. Still fast-tracked over a traditional mining permit. And these are a lot of you use a lot more community contractors to run it. So if we have a quarry in Forestville, we might have 1 or 2 of our own employees, but there might be 20 local contractors who have their own entrepreneurial businesses, trucking, hauling, drilling, blasting, that we're going to bring in to do that. So we wouldn't necessarily bring those employees on as staff, but the guys who already have these specialized businesses would become part of our extended family or extended team. So it brings new jobs and opportunity to the community, to guys who live there, as opposed to some mining communities where you bring guys in from across the country.
Yeah,
who are just parachuted in, and they don't really become vested in the community. They're vested in the mine and then fly out back home. If we're going to do work there, the money's going to stay. The contractor work will stay in the community, which is kind of, I think, why we have the support we do on the North Shore in Quebec.
Well, Michael, this has been a great interview. We spent a lot of time on the Spanish acquisition, obviously, because that's the really big initiative right now, and we had a chance to touch on your industrial minerals in Quebec. So we'll kind of put an end to it there and have you back on so we can talk about the quartz and quartzite in Quebec. But you're getting a great explanation. It makes a lot of sense as to why you're focusing on industrial minerals. You've got history, you've got experience there, and like you said, it's a lot less volatile. And I think a lot of investors out there are almost tired of volatile and want to see something more stable. So I think you're in the right path.
And near-term cash flow doesn't hurt either.
Yeah, but I think that's the miracle word for all investors in this junior resources space. Cash flow, where the company doesn't have to keep going back to market all the time, keep diluting because they need money to keep the lights on. So what you're doing is exciting, and I said this is part of small cap 2.0. You know, just like we had the .com bubble burst, and internet companies have come back smarter and better with real business plans, and look what happened. I think that's what's happening. Right. That's what's happening here. You know, this small cap 1.0. We had too many fly-by-night companies that were just doing deals for the sake of doing deals, just to sell paper. And eventually, we all know that was going to collapse. It did. And there's a tremendous washout in the last 3-4 years of epic proportions. But I'm convinced that the next 10 years are going to see companies like Fairmont leading the way, because they're going to be real. Financing doesn't exist anymore for the George's Gold Company, because I saw a shiny rock and a piece of property in Greece somewhere. It doesn't exist. And the only companies that are going to get financed are companies like Fairmont, and that's going to be great for everybody. So congratulations on this first step, and hopefully you become one of the beacons of small cap 2.0.
Thanks very much, George. Great talking to you.
You've been watching Michael Dane. He's President and CEO of Fairmont Resources. The company trades on the TSX Venture Exchange under the stock symbol FMR. Now, if you want to find out more information about the company, and you should, because take a look at the things they're doing, get yourself over to their website. That's fairmontresources.ca. Take a look at their fantastic presentations, their press releases, their great team, and their plan. And I think you'll be as convinced as I am that this is a great company that's onto some great things. Thanks for joining us, everyone. Thanks for being here, and we'll see you next time.